And hello, everyone. Welcome to the Real Estate Show on KCMX News Media 880. Pete Belcaster and Joe Brett, the real estate guys, in the house with you today here at KCMX, along with Guy Giles from Bank 34 Mortgage, who is our mortgage expert here on the Real Estate Show. So we welcome Guy as well. We're both real estate brokers with John L. Scott in Southern Oregon, and we get together with you once a week here on KCMX to talk about real estate issues. We've never run out of things to talk about. Don't think we will today because there's so much going on around this market that I don't even know where to start today. So anyway, Guy, welcome to you. How are you doing?
Busy.
Grab into that thing there, Guy, right there, whatever you do.
Busy. I don't think there's enough hours in the day. Usually when I get done with this show, I can go back and do something other than work, but I think I'm back at the office for 3 or 4 more hours tonight.
Yeah, you're still working.
Yeah. I mean, there was maybe in January a tiny bit of a lull, but I need to learn to just embrace those next year instead of getting worried, because I always forget exactly how many hours it takes to do this job during most of the year. So,
yeah, it does, doesn't it?
Yeah.
Well, tell us what you're seeing on the out there in the marketplace right now. We talk about how busy it seems to be and all of that. So from your perspective, which is the brokers bring the little loans to you. You've had people coming to you as well. So tell us what you've got, what you're seeing in the market so far.
Well, pretty much conventional loans lately. It seems to go in where I go through a big group of veterans, and I do have 3 or 4 veterans in my pipeline right now. I always tend to have a lot of those, but a lot of people buying their first houses, 5, 10, 15, 20% down, just, kind of whatever. I guess one of your buddies, JJ, has a listing over there in East Medford yesterday, and I happened to look up the address for one of my buyers, and it fit for that 3% down, and he was happy to hear that, and it's just an extra thing, that you can market. There's actually a pretty big spot of land by the freeway.
Okay, stop right there. I want to ask you, because you just said one of the issues that always comes up with clients is how much do I have to put down on a down payment on a house? And I've heard you say a number of different varies right there. When I bought my house, I had to put 20% down. What'd you put down in your house? Remember?
It was about 8,000, I think.
Well,
towards the purchase price. Yeah, because mine was not a typical mortgage, though. So it was done differently.
Okay, we won't even go into that, will we?
Yeah,
okay, never mind that question.
Yeah.
Okay, so today.
Yeah, just depending. I mean, if your income's under the median value for the area, then you can get in with 3% down on a home ready program. So it's basically
3%.
Yeah. Now.
Okay. That's really good.
I mean. That said, there are stretches of properties in Medford, in even Ashland, that don't have any income limits at all. So if you have an address and you're a realtor or you're a person, you can just shoot me an email with an address. I can look the thing up pretty quick and see if it fits for that. But I actually had a lady that we're closing on tomorrow. Just graduated from college. She's a nurse, and I decided to look that property up. Within 1 block, she wouldn't have been eligible for the product, but
really?
Yeah, the rates are actually a little bit cheaper. The mortgage insurance is subsidized a little bit, so it's a little cheaper, and you can come in with just 3% down.
And these are regular conventional loans?
Yep. So you get rid of the mortgage insurance at some point.
And no mortgage insurance?
You would have mortgage insurance. It's a little bit cheaper, but it does go
cheaper.
Away. So it's not like the FHA where it's there for life, unless you have a bigger down payment.
Yeah. Wow.
So it's actually it's a good option if you can kind of fit into it, and especially with some of the USDA going away in our area.
Now, you brought USDA loans up. Wasn't it, Joe, if I remember right, when we started our show in 2009, and Guy, I think you were probably around then, if it wasn't for USDA loans back then, I mean, the market in Klamath, Jackson, Josephine, Douglas County, the coast, the only loans that seemed like were going then were USDA loans in those areas. Now, but today it's totally different. You hardly even give USDA loans out.
I haven't probably done one in 2.5 years, so it's
amazing.
been a long time for me. Well, the issue is that it is a good program in that it's restrictive as far as I think they probably still have the lowest default rate. They do their due diligence, but really it's just difficult to fit into that bucket sometimes. If you have over if you make over $72,000 a year, then as a family, and I know that sounds like a lot of money. But by the time you factor in a car payment or a credit card and then the lower debt to income ratios that they'll allow, there's just not a lot of people that fit into the bucket.
So today, tell me about FHA loans. I mean, are you doing many of those? Because again, you got conventional loans, FHA, USDA, VA loans are or cash, right? Those are the only ways, or owner carry, I suppose, that we don't like those necessarily very much.
No,
but,
I still get calls on those, especially from growers trying to come to town saying, hey, it said special financing in there. And I was like, yeah, you're going to have to call them for that. But, as far as FHA, if I can avoid an FHA loan, I do. The only time that it really, really fits, obviously with a little bit lower down payment, but if your credit score is not great,
So when would a person want to either come to you as a lender and say, I want to do a conventional loan or I want to do an FHA loan, and they don't know which is which? What should they? What's best for them?
Probably
how do you steer them into one of those?
Yeah, then? Well, and steering is probably the wrong word.
The wrong word. That was
against the word.
At the end of the day, we just I mean, if their credit score is decent, maybe over 680, 700. The mortgage insurance is what really makes it, you get hit hard on the conventional loans. You're stuck at a straight 85 basis points for most 3.5% down, or for 3.5% down, and that's just a percentage. It's a fee that you pay in mortgage insurance, and it can triple or quadruple if you have, technically you can get a conventional loan with a 620 credit score, but the rate you're going to get, and then the mortgage insurance can be hundreds of hundreds of extra dollars.
It's going to cost more than is what you're saying on the FHA side. Then
so I mean,
I hear nothing. I mean, I've had clients. I've had one FHA loan. I think in the last year or a couple of years. Really, they're mostly now conventional loans that we're seeing out there in the marketplace. Not all, but most of them certainly are.
And sometimes you'll have a family member or somebody that can put in another 1.5% to get you to that 5% if you don't fit into one of those demographics that'll get you into a 3% down. And if you can get into something like that, or I think it's more about just getting in the game right now, period. I have a few people that just sat on the fence over $2,000 3 years ago and didn't buy the house. And if you look at the appreciation rates, I mean, even if it's not the ideal one, if you look historically, we're going to have some sort of a recession in the next couple years.
Well, now it depends. I think that I mean, I understand what you're saying, but if things level off a little bit, then but the economy is doing well right now. It just shows no signs of slowing down. So I hope you're wrong, big guy. There, I hope you're going to be off a few years or something.
I have not called for that at all. I mean, I think these are the best tax cuts we've had since Ronald Reagan, and I think that's good for the economy.
Only tax cuts since then, I think.
That's true. So I guess that's a pretty.
They knew how to do that.
And remember, they haven't even taken really effect yet until next year when you file taxes and all those kinds of things. So much of it. So
I mean, jobs-wise, economy-wise,
what concerns us mostly should be the affordability of housing in our valley. That continues to go down, less affordable each month, as we've seen in the statistics show. And the other caution is the rise of how much it raises. The median price goes up, that kind of thing. If it's double digits,
and we're not able to create new inventory in that housing market range where we desperately need it as well.
So we'll see. I'm curious as to we'll find out as we go over the years, won't we?
I mean, it's so funny because that recession word.
It's a big R word. We don't like that. Yeah.
I would have never thought. I'm looking at the graphs historically over the last 40, 50 years, and I don't know that it's going to be something really bad and ugly. So please don't take that. But I guess what I was saying was that even if you're not in the greatest one right now, you might see some dips in the next couple of years in some rates. If we do see a little bit of a pullback, that might be your opportunity to get out of your mortgage insurance or just get a regular lower rate.
Are you seeing people doing refis? I know you talked about that last time you were here a little bit. You saw a bump in that. Has that slowed, or is that still continuing because of people thinking about where this might go?
I am doing a few. So some people were in some financing that they just had to be in during the course of this whole last correction. And so I'm doing a couple of those. People have some private notes, and now it's time to get out of those. I got one guy that's going to take a little bit of a higher rate just because he has to be out of that one. But it got him into the house. he only put down, I think, 20%, and now he has 40% equity in that place, and it makes sense. So.
Well, the biggest thing happening right now in the market, as we sit here in mid-May, and we're talking about April stats now, but Guy, and I'm curious as to as we go through this, what you think of this thing. Well, we saw during the month of April as compared to the month previous of a year ago, April 2017 versus 2018, pending sales were up by 10.5% in Jackson County. New listings were up by almost 30%, which was a big increase. Over 100 homes entered the market additionally. The average day on the market was 28 days. That still amazes me that so much sells under that, which is remarkable. Available homes per buyer is 3.8, but what's happened is that the month supply of inventory, which has been so low, a year ago it was 1.9, has jumped to 2.4. That's a 27% increase. So what is that telling us? What do all those numbers tell us?
Well, we need the inventory.
Inventory has increased. Absolutely, inventory has increased, but there's also more competition now. So there's more homes. Month supply of inventory has increased as well. So buyers have more of a choice.
But
there's more inventory,
need it too,
and buyers need that.
Yeah.
So again, a 6 month that supply of inventory is a normal market, and we're maybe halfway there, kind of. So it's still. But again, it varies where you're at. The luxury market, I'm telling you guys, continues to have. I don't know if everybody in Jackson County, or in Josephine County for that matter as well, who have luxury homes or have put them on the market.
You saw a bunch on tour this week.
There were 4 just on our Ashland tour Thursday. 4 new ones.
Yeah.
And they're not. And the thing is, they're not selling. They've got almost a 2-year supply, of maybe more than that now. Inventory in that particular range. So that is a buyer's market in the luxury market. Whereas you go down into that $350,000 range, $250,000 range, and we're still, in many times, multiple offers, and still that is where people. That's where most people can afford.
Got to roll up your sleeves.
I don't care what you say. And when you get up higher, there's fewer people out there looking.
I'm telling people to trust their real estate agent and go in with a good, strong offer, because you're right, especially those lower ones. You could write 12 pre-qual letters for somebody that's gonna, it's a buyer's market, right? And it's like, no, it really, it isn't. And they think that you're still going to walk in and ask for a bunch of closing costs and ask for less money. And if you don't go in with a good, strong offer, and a good pre-qualification letter from a good local lender. All that stuff just puts you a little bit above, the next guy.
We've got a break coming up here, but are you getting lots of requests for pre-approvals and getting that thing out there? So you're actually finding that you're chugging things out right now again.
Yeah, I mean, even after I got home from work last night, I wrote 2 more pre-qualification letters.
Wow!
And thanks, Gary Stamps. We got
we're going to take a break here. And when we come back, I want to ask you kind of, where are these people coming from? What are they looking? What are they buying? Because you're kind of right in the insights of all that as well. There's so much going on. Home ownership rates are up in this country. People are wanting to buy again. It went down, to a historic low, and now we're coming back up. There's so much going on in this market as well here in Jackson and Josephine County. With Guy Giles from Bank 34 Mortgage, we've got a whole lot more to go. The Real Estate Show continues here on KCMX right after this. And welcome back to the Real Estate Show on KCMX News Media 880. Pete Belcastro, Joe Brett, the Real Estate Guys, with you here today, along with Guy Giles, he's a mortgage expert from Bank 34 Mortgage. Guy's been. I don't know how long Guy's been with us now. It's been like 4 or 5 years, hasn't it? I mean,
seems longer.
That's what everybody says. My wife thinks we've been married for 40 years. But
well, what's interesting about it is we've seen you kind of go through this as well over time in lending and the types of products that are out there and how you qualify for loans. And again, tell people, Guy, because I guess it's the number one question. The first question I ask clients is, are you qualified for a loan? And if you're not, then we need to talk about how to get that done. So what are the things that things that people need to get qualified when you talk to them?
I'm a huge proponent of even if you got qualified 7 months ago, I just actually got a phone call not a half hour ago from somebody, and she said I was pre-qualified last year. Yeah. And and now I'm ready to go again. So I started talking to her a little bit, and I said, you have to understand, whatever numbers you were talking about last year, you're gonna change that by quite a bit. We're probably 5/8 up in actual rate.
In the last
mortgage
year.
Rates, okay.
Yeah.
I mean, it's pretty amazing how I mean, we all knew it was happening. You know, it's nice to be able to try to catch the little dips, and I get the live mortgage-backed securities on my desk throughout the day. It's something I kind of pay extra for because I think I owe that at least to my people. But literally, I mean, it's like I heard it today equated to a kid on an escalator with a yo-yo. You know, I mean, it's kind of going up and down, but really, that whole escalator is going up. You can try to catch the little dips, and you can do what you can, but at the end of the day, just getting locked in, I mean, 1/8% in rate is going to be what, $3-4 a week. I mean, it feels better to have an eighth lower. But
now I remember you saying last time you were here, you had for people like Joe and I, or whatever, or at least for me anyway, self-employed people. That has always been kind of a bugaboo for self-employed people getting loans. But you say that's kind of easy now, making it easier to count something there for people like me.
I mean, as long as it's real. I mean, it's one of those things where you do have to have some of your own assets, and it's a bank statement loan where if you've been in business for a few years, we can just take a look at your bank statements and qualify you on that. So, I mean,
doesn't that make sense? I mean, that really does to me. I mean, people have been in self-employed for years. I'll tell you, if you're not making it, and you're still self-employed, you're not going to make it. So you've made it. So you should qualify for a loan.
And the last guy that I just did on this program, I mean, he's got really good income. He doesn't show it on his taxes, and I think that's how this whole thing got started years ago. Unfortunately, they just started extending all the stated income loans to everybody, and these guys actually are documenting that they've been in business for a while. They're documenting their gross receipts. They're documenting their assets. So it's not like some kind of a crazy liar's loan like was happening before.
And what are the items when you talk again to people and say like someone's going to call you, we refer people to you and say, you're going to say you need to bring me what so I can get this done?
The first thing I'd look at is if you're talking self-employed.
Either way, I mean, way it doesn't matter.
Well, for self-employed people, I ask for your tax returns straight off because there are a few things from your bottom line like depreciation that you can add back. I mean, not a ton, but definitely get your taxes in so we can analyze them. And if I can do something a little bit more traditional rather than the bank statement loan, it's not a bad loan actually. The rates are a little bit higher, but really not prohibitive at all. Especially in light of some of the stuff that I brought in today, as far as what you really gain by actually being in the game rather than waiting. So you're looking at 2 months bank statements for your typical buyer, couple years W-2s, 30 days pay stubs, and really, so you got your assets, you've got your
all those things.
And you bring those in, and we'll pull your credit. We'll take a look at that and just and look at it. And I like to go a little bit deeper than just, hey, I can pre-qualify you for $450,000, especially with first-time home buyers. I like to talk to them about, kind of this is what your payment's going to look like, and I know you're only paying $700 for rent right now. While you're looking for a house, why don't you pay yourself this difference, put it into a checking account? First of all, you got a little bit more money saved up by the time you buy your house, and second, that's a nice way to try it on. So you at the end of that month or 2 months while you're, kind of just getting serious about it, how comfortable that was, so we can adjust to see if you want to go a little bit higher, a little bit lower, and so it's really goes beyond what you can qualify for. But really,
well, it's dynamic. Millennials are buying homes in this U.S. home ownership rate I was talking about in the first quarter of 2018. 64% of Americans own a home. Okay, 64% home ownership. And of that, they said what's interesting about it is the millennials, 9 in 10. I mean, think about the market for this, because the millennial generation is bigger than the baby boomers now, which is us. Okay, so we're not top dog anymore like we thought we were for all these decades. Anyway, 9 of 10 millennials plan to buy a home, and of the prospective buyers, 35% plan to purchase a home within the next 2 years. 50% plan to purchase in the next year, and 57% plan to purchase in the next 2 years. That is an enormous amount. And what happened is that the experts thought the millennials were going to be renters. They weren't going to buy into home ownership in the country. It was going to change. Remember that? Remember those discussions?
They're going to live in yurts.
That's not happening. Millennials plan to buy a home. 9 of 10. So that's going to create an enormous. It's going to create enormous for loans. Think of this.
What homes are they going to buy? Our poor millennials. It's going to be hard to
and the affordability of it. That's the other thing. It's the affordability of it.
Well, yeah, and that's one big thing. If you can somehow get your college done without a bunch of student loans, I do think that's one of the looming.
Is that hurting
things.
people? Because I hear that it
funny,
doesn't count on
one of the biggest
some
obstacles.
loans.
It depends. Like on a VA loan, if you see that it's deferred for more than a year, you don't have to count it. But it doesn't really make it any less real, to be honest. It's just I do believe that's one of the things that probably Congress will have to address, just because it's going to be the biggest ugly.
Well, there's
thing
still,
ever.
and they're still accumulating student loan while we speak. So it's not like it's that crisis is.
And that's the thing. Even if it is deferred, it's not like you're not paying on that. It's not like your thing's not growing a little bit.
Right.
So I worked when I went to college. So if any of you young guys like they're really listening to the radio, but try to work a little bit and take a little bit less debt as far as that goes, because I do think that's going to hurt us the most.
The less debt you have, isn't that true? We've all been through that.
How many students did we see in our time at SLU who worked so hard outside of their classes and athletics and other activities that they had to put themselves through and to not have to carry that burden afterwards? It takes a lot of commitment and dedication to get through college and to earn that for yourself.
No student debt. We see it, and you're right. And the smart ones work their way and work their rears off, not to have that debt, and others just go in and just accumulate it and just are going to pay for it later.
The rest of their lives,
it's like it's like deferred maintenance on your house. We talk about that all the time. And you think you're going to get away with it, or someone's going to go bypass it, but you're going to either pay for it along the way you go, or you're going to pay for it at the end when you sell it.
Tens of thousands of dollars we're talking in student debt that some of them graduate with, and it takes years till they're in a position to have a job that pays enough to where they can throw some money at that and really knock it down.
But I am seeing a lot of kids that do make it through. They might have a little bit of student loan debt or a little bit here and there, and they're actually really prepared to buy houses. And
we're seeing that.
Yeah, and I don't see them making a lot of the mistakes that a lot of people
that's pretty
my age.
Well,
did. I know I made one.
I hope that young people, and we had Deidre and Nick Ripson were here a few weeks ago, a young couple who were doing really well, and it's that same thing. You invest your time and your efforts and all those things into it, and look what you can accomplish. But the nice part is that age group, they're going to be buyers and they're going to be consumers as we go along, and they're going to do it. What about investing? I brought this chart along. I don't know, Joe, if you can even see this on this thing here, but in 2011, it's America's choice for best term long investment. Okay, and we talk about this is why millennials, I think, want to invest in real estate. You're going to create wealth for yourself. In 2011, the number one choice was gold, 34% of this thing. Real estate was 19%, and we were in the middle of the recession in 2011. Remember that? There was nothing going. There was nothing selling hardly.
Not a hot market.
And if you go forward to 2018, real estate now is at 34% as America's choice for best long-term investment. Stocks are 26%. Gold has dropped to 17%, and savings is 15%. Those people are crazy because they don't make any money in savings. You got to invest it into something, do you? Anyway, so real estate is still, the bottom line, is a terrific investment. And I think millennials are the next group that is obviously seeing that now, because, as we say in our statistics, 9 of 10 are going to buy a home.
Well, and even the house that I bought that my kids grew up in, we were in there about 18 years. The track record, and I still have that house. It's a rental now, but I had it through the whole crash, but there was a big run up before the crash that I had it all the way through. And I just did some math, and it averaged about 4.3%, 4.38%, I think was the exact number, over the last 18 years, and it turned something that I paid $135,000 into. Now it's probably worth about $370,000.
Yeah, wow.
So just being in there, waiting it through. It's not one of those things that that you're gonna flip a house and make a fortune at right now. Those people try to stay away from those seminars if you can.
Well, there's still investors out there. Are you seeing that? Investors coming around?
I got one young kid. He's 23 years old, buying his third investment right now.
Wow. Really?
And he still lives at home with his parents. And he's this kid is doing it right. You don't think about too many guys you'd want to introduce to your daughter, but that might be one of them.
Well, it sounds like a third investment, your third property. And I've got some folks also have been looking, and there's always properties out there, in the price ranges and that need a lot of work. And people are willing to take those on. And I think flipping them is one thing, if you flip a house, but if you invest in the property to rent it to make an investment, that's a totally different use of it and a different mindset, I think, for it, how you're going to fix it or do anything with it.
Our friend Eli Matthews comes to mind. Our
yes,
Medford City
travel
Councilor,
yeah.
That's part of his portfolio of going forward in life, and he grew up in that. His parents had rental properties, and now he's got his own and is really setting himself up nicely.
It's amazing how many people actually have invested in rental properties. Some of them manage them themselves. Some of them have property managers do it. But they've invested in that to create wealth and to create some income for them. It's great.
That graph you showed, when real estate took off, it was at its low.
Oh, it was awful.
That's when
they
really swooped in and got that's when the investors really made their move.
How many times, I think, when we back in 2009, 10, 11, in those years, how low how low prices were. We were thinking, boy, people should invest, and those people who did in that frame,
had the money.
If you had the money, that would have been the time to do it, because since then, of course, it's come up, isn't it?
And more people have got on board, and confidence in real estate has returned.
And let's face it, Jackson and Josephine counties are still great attractions. The demand is not going down. In fact, the number of lock boxes, which is a good indicator of how much activity there is, again, when you hit 10,000 of those in a month, it's a lot of boxes being opened, a lot of people looking. And then they're buying, but they're looking. I think the question is the pricing too high for some things, if it's staying, or conditions or whatever that reflect that. But there is still a lot of activity. If you're not getting activity on your listing, you're either too high. I mean, that's kind of the bottom line.
And watching the last few months for my buyers that were seeing prices just out of their reach, they're coming back now. The sellers have had a little reality check and are having to come back to the buyers to where they can make it work.
Hey, we're with Guy Giles from Bank 34 Mortgage here on the Real Estate Show today, talking mortgage interest rates in the market as well. We got a break coming up. We got one more segment to go. Pete and Joe, the Real Estate Guys. Don't forget, you can check out any of our past shows at realestateshoworegon.com. We're coming right back after this. And welcome back to the Real Estate Show on KCMX News Media 880. Pete Balcaster and Joe Brett, the Real Estate Guys, with you, along with Guy Giles from Bank 34 Mortgage, talking mortgage interest rates. It's always a topic that I love getting. Guy, give me a rate. Tell me when I come into you now. What's the rate that I'm going to get? And I've gone to that range rate.
Yeah.
And we've learned this part of it, which is really good. If you want that 4.7%, that low end of that range, you better have a pretty good credit score and that kind of thing, right?
Probably a little bit of money for points at this point.
Okay.
And actually that's starting to pencil out a little bit more. I took one to the complete extreme with my assistant a couple weeks ago, where we had him paying like 10 points just for fun.
Okay, tell people what does that mean so they understand what you're saying.
You could take the word point and just throw it right out the window and put the word percent in there.
Right.
Yeah. So if you're paying 1 point, you're paying 1% of whatever your loan amount is. So
now, why would I want to do that though?
Well, it would really depend on your goals.
Right.
For a long time, they weren't really priced to where you'd really want to pay them. I mean, they just, the way Freddie Mac and Fannie Mae kind of rolled these things out, it didn't make sense. We were doing what was called par pricing, where you're really not paying for any points. And I don't necessarily suggest that you do it all the time, but it's definitely worth a conversation, because lately paying, a quarter of a point, a quarter of a percent, or a little bit.
Quarter of a percent of the total. What does that do for me, though?
So if you can get, I mean, it really comes down to just the cost versus what it can do for your rate. It would just buy your rate down a little bit.
Just a little bit.
So,
okay.
Well, and it depends. All the online lenders that I've ever got a good faith estimate from, they advertise no points, no whatever,
right.
but I have a drawer full, literally, of good faith estimates where they don't call them a point, they call them something else. But when it's apples to apples, every now and then you'll have one that's just a little bit better than us. But for the most part, they're just these online places. They're cold. You'll never see a face, and some of them will close okay, as long as everything's all right. But if you have one little bump in the road, all of a sudden they're on to the next deal because they're getting 400 of them an hour brought into their system.
Sure.
And they'll just throw you under the bus, and you're done until I mean, I've just had it happen 100 times where it's like, hey, they just fell off the map, and I don't know what happened to them. So
how often does someone actually would buy points?
Well,
does it happen often?
With me, typically they don't.
I was gonna say I've never really had much of
that.
But
I've just been digging a little bit deeper into the pricing and the way that they're doing it right now, and some of them are actually it's penciling out to pay just a little bit as far as the points go. Yeah,
Okay.
the cost of it is. It was really expensive for a while, and there's I could go pretty deep into
No, that's all right.
that, but this is I mean it's just about getting in the game. Like I said, even if the rates are up just a little bit. I mean I did some numbers on a appreciation. It's actually a little bit lower than mine averaged. Again, all the way through the crash. If you bought a $300,000 house right now, if you hung on to that house for 15 years. You'd be at about $562,000. So if you just think about spending rent for the next 15 years, so I mean, I just been doing a little bit of thinking about that with people that are kind of on the fence. I'd never want them to go in, over their head. But if you really look at the appreciation that you're going to get on your house, and also you're not going to owe that much at the end of those years. You're going to end up owing less because you're paying the thing down. It just really works out. You're just at the mercy of a landlord that's going to raise your rent or kick you out when they decide to sell their house, or I mean, I don't know. It's just a good way to kind of take control. I don't have really coherent notes, or at least I'm not great at putting them together. But even waiting 3 years on a $300,000 house, that house just at that regular appreciation rate will be worth $330,000. So that will diminish some of your buying power. We have options with like Hayden Homes right now has got some pretty good new construction. You're looking in East Medford for they started about $260,000 for a house.
Right.
And I mean you get to pick your own paint at that point.
Isn't that the area off of Spring Street that Hayden is developing in that area there off of Spring Street? It's met by Providence Hospital. And they look like they're selling those. I mean, those are affordable in that range. I mean, that's more affordable than the 3 and the 4s and the 5s that we're seeing.
They're building those too,
built.
but that's really neat that you've got those. Yeah.
Yeah, there's Jeff Addington and Brian Pollinger are both in there, and they're there 7 days a week, selling these houses. And pretty much as soon as they release more, they sell them, and they're actually booked out on some of them that aren't even done yet.
Well, it's an affordable price. If you look at all the stats that we show here, those are right in that range. That is the range. It's just
pent-up buyers waiting for them.
A lot of pent-up buying. Yeah. Wow.
Oh yeah, it's and again, you're not worried about a roof. You're not worried about a heat pump. You're not worried about really anything. You'll get a good warranty when you buy it.
Well, it's new construction.
Yeah,
I mean, it is kind of thing. I certainly see sellers offering 1-year home warranties more lately. It seems to try to make a buyer feel a little bit better about about things. Tomorrow, of course, is the John L. Scott Open House Extravaganza that they do once a month, as you know, and that's a big event. There's tons of people come out, to look at properties during there. That'll be the circular, will be in the Mail Tribune tomorrow, so get a chance to go out and look at properties. Right. There's a lot of them on there, and you got to go look at them. It doesn't do any good to sit and just look at a picture, because how many times do you say, geez, the pictures didn't do it justice, or the pictures were kind of, did their thing on us. And so that's really an important part, to get out and look at them and take so you make a better choice. But again, the inventory is up. So remember that there is more out there than was a month ago. So we have 100 more. 100 more properties than were a year ago.
Glimmer of hope for you.
Well, this is the time that they're going to be done. I mean, May and June is the peak time for listing properties, and then it's going to start to go down. So everybody who's getting them on are doing it right now. So that's why we're seeing so many on, and there's a lot of stuff coming.
Guy's busy, but his phone's just blowing up over here.
I wish I had as much business as Guy did. Anyway, it's the way that thing goes.
I don't know. I wish I had a different job. I got a gal right now. She's super cool. Lorelei, I'm doing a loan for her. She hasn't owned a house, and her job is running around doing the power lines. She's a forester for the power company. And she gets to run around in a helicopter and look for potential trees that'll fall into the lines, and she GPS marks them. And I'm like, man, why don't I have a cool job like that?
Right?
Yeah,
I like that.
Anyway. Yeah, well, that would.
But she's one of those crazy ones. She gets up and runs 100-mile runs in the morning. So I don't know about that.
Well, we hope that you, when we see you next time, it'll be interesting. We'll be in June next month, and when we talk to you then, Guy, and see how all this is transpiring in this last month. I'm so curious as to what the next 30 days are going to be. because school will be out. People are going to be here. There's going to be a lot of people running around, and all this. A lot of people will still want to come here, and I think it's going to be very interesting in terms of sales. John L. Scott is. Just amazing to me how much is going on in our two offices in Ashland and Medford, and its other offices as well. So there's obviously great demand going on, and it's trying to find it, get it low, get it done.
Don't tune in June and still be sitting on the fence and have Guy come back and says interest rates have nudged up a little bit and your purchasing power is going down a little bit. Come back in a month and be pre-qualified with him and have a contract in hand and be pending.
It's super important, just give me a call, come in, we'll get you actually pre-qualified, not just or pre-approved, not just pre-qualified, and then you're really ready to go.
You you have to be ready to go, or you're going to lose out on the property that you really want, and we don't want you to do that.
Or the buyers will be zooming past you.
Be ready
on the way to pending.
All right, Guy, nice to visit with you. You can catch Guy Giles. You can just Google him at Guy Giles, Bank 34 Mortgage, or email at guy.g at bank34.com. That'll do it for the Real Estate Show today. Thanks for joining us. Have a great week, everybody. We're back next Saturday right back here on KCMX. Have a great week, and God bless you all.